Hello and welcome to the 3 trade strategies video. Let's take a look at what we will be learning in this. The past is a good place to start. No system is guaranteed. You may have to combine strategies and only trade what you can repeat. As the saying goes, history does not repeat itself, but it does rhyme. The problem most new traders have is that they want to reinvent trading. It is human nature, after all, to take a task and try to do it better. When it comes to trading, people have tried this for decades. From rocket scientists to computer programmers, people have tried to find a guaranteed way of making money in the markets. It simply does not exist. Essentially, we all have access to the same information. Remember that not so long ago, information was scarce, and whoever would lay hands on it could well gain an edge against competitors. However, in today's internet explosion, information is abundant, and therefore the problem is really how to correctly interpret it. The markets, especially the foreign exchange ones, trade 24/6. This means there are tens and hundreds of trading opportunities every single day. The markets will be open today and they will be open tomorrow. The key is to finding out which trading opportunities will work for you. The best trading strategies are ones that you can easily identify and are also easily repeated. Remember, history does rhyme. The key to overall trading success is consistency. This is what your trading strategy should provide you with. Going with the trend, use of the Bollinger Bands, Fibonacci and the key 50% level. The past, use higher time frame support and resistance. As per the saying, going with the trend can be seen as your friend. Not as easy to implement though. Most traders who trade into momentum enjoy a higher degree of success. If more people are buying than selling, the markets go up, and if more people are selling than buying, the markets will go down. It is a very simple concept. Trading with Bollinger Bands can be seen to be highly technical. This is not the case. Bollinger Bands are used in trading as they utilize one of the simplest trading principles, the moving average. Bollinger Bands, as we said, use the moving average. This is, as it sounds, using a sample period of data, usually 20, and then plotting a line of support and resistance around this average. When the markets trade towards the upper band, resistance, then the markets should sell off. When the markets trade towards the lower band, the support, they should buy back. The whole point of using the trend is to decide which trading option is better. Now let's take a look at this example. Looking at the direction of the markets and the Bollinger Bands, the trend is clearly down. The candles are making lower highs and lower lows, which forms the definition of the downtrend. There are more red selling candles than green. The Bollinger Bands are moving in a downward direction. You can clearly spot the 3 topping points marked on the graph with small light blue frames. These are all situated also on the upper band of Bollinger Bands. If we sell when the market trades inside the Bollinger Bands, then usually the market will sell off toward the midpoint of the Bollinger Bands. Remember, this is the moving average. When the trend really starts to kick in, then the markets will sell off high to low, and will then target the opposite Bollinger Band for support. This is a simple way of using the trend down to sell high and use the upper Bollinger Band for entry and the opposite Bollinger Band as an exit point. The most popular, however, interpretation of the Bollinger Bands is that of explaining volatility. When the bands are narrowing, it means that we should be expecting a higher volatility. It means, in essence, that the moving average is becoming flat, so we do not have major fluctuations, which in turn means that the market has discounted the news, and therefore it is waiting for that catalyst, which will result in a price shoot, either to the upside or downside. You can clearly see the narrowing of the bands in our euro against the Swiss franc example. On the chart, we can see the narrowing of the bands back in May 2015, which then resulted in a major move upwards. Same direction in December 2015. Another example can be seen on the dollar-yen exchange rate from its lower levels back in July 2014. The bands narrowed, and that resulted in an increase of volatility and its price from levels of 110 to those of 120. Now that we have established how the Bollinger Bands help us gain an edge, we will take a closer look at the Fibonacci indicator. Now, Fibonacci was a mathematician in the older times, and what Fibonacci indicator does is using the past move in the markets to create a scale of where and how it can move in the future. Fibonacci can be difficult as everyone identifies where to draw the scales from. This is down to you to decide. It is, however, prudent to choose the swing low of the specific time frame you're using to draw the Fibonacci and extend it up to the corresponding high of that time frame. All the levels are important, but the 50% appears to hold the most significance. Let's now take a look at the example in this slide. We have identified a strong move. A strong move is when the market has picked a direction and there, in this case, more green candles than red, as this is an up move. Also, there are a significant number of higher highs made. We have also drawn the Fibonacci line from the swing low of this time frame as discussed. Once we identify that the move may be over, no more highs are made, we can say that 80% of the time a strong move will retrace to the 50% Fibonacci level. This also does not mean that it will not retrace to all of the Fibonacci levels. You can certainly get 100% retracements from the highs to the lows. As a matter of fact, for most traders, there are two more significant levels, the 38.2% and the 61.8% Fibonacci retracement levels. The 38.2% is frequently seen as a take-profit level, while the 61.8% is seen as a major signal of a serious change. These two levels, combined with the 50% level, will help you as a trader identify your key entry and exit points. You can always combine strategies or technical studies. In this case, you could add the Bollinger Bands to the chart. This helps identify the top of the market, where buyers have left. For instance, take a look at the chart which pinpoints the strong upward move as before. You can then draw the Fibonacci scale from the start of the move to the end. Your key 50% Fibonacci level is then the target. The Bollinger Bands can also act as a secondary confirming indicator of where the market may find support. In this case, the Bollinger Bands support the 50% Fibonacci level. We can clearly see this from the chart while we have drawn the light blue frame at the topping level touching on the upper band of Bollinger Bands. All in all, a combination will help you identify the tops and bottoms in each move. The past is something very important in trading. Remember that history rhymes. We don't know the future, and this is essentially what trading is, trying to predict future movement. You might have heard of an economist from the past century by the name of John Maynard Keynes. He used a metaphor to say that the stock markets are like a beauty contest, in that we all try to anticipate what other people try to anticipate. In this way, looking to the past is the best way to gauge what could happen in future movements. What goes up will eventually come down. Buy lower, sell higher is really what most people aim at doing. Here, we provide you with an example of more than one time frame and its advantages. We are using a daily as well as an hourly chart. Daily charts are good because highs and lows, opens and closes are set in stone. All the important information that you need as a trader is in these four elements. When you trade from hourly and below time frames, things are a lot less certain. From the daily chart, we can see clearly that the trend is down. There are levels where the markets have reached on high points and low points. If you look at the hourly chart, what is more likely? Will the euro against the British pound get to the 0.79275 previous daily high, or the 0.76899 daily low? In the short term, hourly chart, the overall daily trend is more likely to provide the answer, sell high. The combination of different time frames is really key to your success. For you, it might be the use of a weekly time frame combined with a daily time frame. For others, an hourly time frame combined with a 4-hour time frame. In other words, seeing the big picture within your trading style is really important. Now let's take a look at our last strategy, one that has proven to help millions of traders like you. A strategy on a multiple investment horizon using the MACD, the moving average, converges, diverges. The strategy outlines that when the line of MACD is positive, that is above zero, then my trend is considered to be bullish. Note that the signal line is a moving average, which is given by any trading software, usually a 9-period moving average. We take into account two investment horizons, that is, two different time frames, as typically these will interact. For example, we look at the daily time frame and how this affects the 4-hour time frame. If in our bigger time frame, in this scenario the daily one, we see that MACD is on a bullish trend, then on the 4-hour time frame we follow its bullish signals. That's simple. Therefore, if on the 4-hour time frame MACD is positive and is crossing from upwards the signal line, that is the 9-period moving average, then we can deduct that we are on a corrective phase. That, however, does not mean that we are going short. We just do not go long. We actually go long when the MACD is crossing from downwards the signal line and will follow its long signals. If MACD is negative, then I work the other way around. In this example, we can see the sterling against the Australian dollar exchange rate with a multitude of short signals marked in these 4 red arrows in the chart provided. Long signals, on the other hand, we can clearly see at the euro against the British pound chart marked with these 2 green arrows. This system is really one that has helped other traders across the globe and will certainly help you set off with this journey. In conclusion, it is simple. Trade what you can repeat. There is no one answer or guaranteed trading strategy. Use a combination of strategies to help you trade. Choose a strategy that fits your risk needs. Trade only when you see your setup. And this way, you can become a successful trader than many others. Thank you for watching.